Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, we have the market rallying, or the market's rallying, the last 2 to 4 weeks. And in the same time, we have a lot of negative headlines. For example, we just came out with the GDP report, and it looks like we are officially in a recession. Well, at least according to normal recession metrics, which is two contracting quarters of GDP growth, if you will. So a lot of negative headlines, and the market's still rallying. You may recall about 3 weeks ago, we started a series based on a lot of questions we're getting from clients and just inquiries. Well, Chris and team have the markets bottomed, so we thought we'd put together this series, and today is the third part of that series. Have the markets bottomed? And it's only anyone's guess, frankly, if you want the real answer, but we're looking for some evidence to help support that. So you may recall that when we talked about this a few weeks ago, we said, okay, well, one of the characteristics that tends to show up when the markets are bottoming, at least when studying history, is when equities are a certain part of an investor's portfolio. So, for example, I noted back then, meaning in the first video a few weeks ago, that an AAII survey of respondents back again about a month ago noted that around 65% of their portfolio was still in equities. Now, compared, for example, to the bear markets of 1990, 2002, and 2009, back then the percentage of equities was 45%. So if you look at this just on the surface, it appears, or at least appeared, that the market still had some more room to drop. That was one of the characteristics. So again, what percentage of an investor's assets are in equities? That was, again, a characteristics that tend to show up at market bottoms. So a second characteristic I talked about in the Have Stocks Bottom Yet videos was peak inflation has been reached. Now, as you know, the good news is gas prices have come down quite recently. And of course, gas prices, of course, affect other things like distribution costs, the cost of products, obviously gas itself. So that's a good thing. So the Fed, as you know, had been raising rates. In fact, most recently they had another 3/4 of a point rate hike, which surprised nobody. They said they were going to do it, and they did that. And they likely will continue. And as you know, they're increasing short-term rates, which is really the only interest rate they can control to curb inflation or attempt to slow down inflation. And it appears to be working. So that's good news. And again, it's showing up in gas prices. So again, the markets tend to bottom, again, based on a study of history, when peak inflation has been reached. Now, the second video I did showed this chart. And it showed that if you looked at history from the 50s, the 60s, to the 80s, as evidenced by this rectangular white box and these lines where this white to gray ascending or upward sloping line is the market, and then this, let's call it yellow gold staggered line, is inflation. You could see where when inflation peaks, the market tends to bottom. And here's where we are in the far right. This again is around 2 weeks ago. This is roughly when inflation, and let's identify inflation as, in this case, gas prices, has peaked. And obviously gas prices and some other products, if you will, and goods have come down a bit. But again, a study of history notes that markets tend to bottom when we have reached at least a short-term peak inflation. Now, if you have not seen the first two videos I just briefly overviewed, you can go on our website at nickelswealth.com. You can see in the Insights tab as identified by this red arrow. You can click on that tab and you can check out those first few videos on our website. Here's what they look like. But today I wanted to talk about a third piece of data that tends to show up when markets are bottoming. And again, there's a number of other things that show up when the market's a bottom, but I just extracted three just to keep things simple for the purposes of this series. So the third thing we're going to talk about today that tends to show up when the market's bottom is that Wall Street analysts tend to be very bearish when they are downgrading stocks, or tend to be very bearish downgrading stocks. So let's talk a little bit about that. So Wall Street has analysts, hundreds of analysts, and every so often, sometimes monthly, sometimes quarterly, they have an opinion on a stock. They upgrade the stock, meaning they have a favorable rating. They usually put price targets of maybe 5-10% higher over a certain time frame. Maybe they're neutral on a stock, effectively saying, look, we don't think the stock's going anywhere. Or maybe they downgrade a stock where they think over a certain time frame the price is going to be lower for various reasons, and usually it's of course financially related based on the balance sheet or wherever they think the economy or markets are going to be. Well, historically speaking, when analysts downgrade stocks, by and large, that tends to indicate that we are near a market cycle bottom. Now, again, I'm not saying that we are absolutely at the market bottom or that a month ago the S&P was at a market bottom. No one really knows. I mean, the reality is this could be a bear market rally, which a bear market rally is basically a short-term rally in a bigger, larger bear market or downtrend. So we could very well be in a bear market rally, or of course, we could be starting a new bull market. Only time will tell. But again, a study of history shows that that overwhelmingly you get a lot of downgrades from analysts, and this is what we're tending to see. So, for example, what does a downgrade, at least from a headline perspective, look like? This is from Yahoo Finance, where, as an example, one of the largest institutional money managers in the world, BlackRock, downgrades their outlook on stocks. When you have an abundance of downgrades, stocks tend to bottom. So let's look at how that actually looks graphically. So this is a chart of the S&P 500. Actually going back a little over 12 years, and you could see, again, this is the S&P, and you could note where the upgrades are this above this lower line here. I believe that's a blue color, so that see the bar charts, those are the upgrades, but you notice the red bars, and to the extent they accelerate on the downside, that's when you see, again, this is indicated or referenced by the downgrades, you could see where the market tends to bottom, or at least nearing a bottom. Now, of course, if you fast forward to the far right, here we are most recently, let's call it the second quarter or even third, let's call it midsummer-ish, where, analysts were very bearish, overwhelmingly downgrading, and we've seen, at least in the short term, a potential market bottom. Now, look, here's the reality of the situation. We have a very difficult economy. As I noted earlier, we're technically in a recession. Now, I know the Fed, or at least the government's changing, their opinion on what the definition of now, recession is. But by most metrics, we're now formally in a recession. We have rising interest rates, which, the Fed has been talking about continuing. And they meet next time, every time they meet, which is around every 6 weeks, they've been talking about raising interest rates. So this is nothing new. You see mortgage rates going higher. So we're having challenging times. This is not new information. So no one really knows if the market is at a bottom now. But again, as I noted 2 weeks ago, a week ago, and even today, there are a number of characteristics that show up when the market's bottom. So what we do is we look at the totality of the evidence to give us an idea, and then we make an educated decision. And ideally, in a perfect world, it works out, right? Sometimes, it doesn't work out, as we always talk about. The past does not always equal the future, but it tends to rhyme with the future. All that to say is, there's a lot of concerning things. Let me just share a positive thing. Unemployment is still fairly good. I think the most recent report is around 3.5%, somewhere around, in that range. So, I don't know that things will get really challenging until you start seeing severe layoffs. I think that'll be the, let's call it the nail in the coffin that may confirm that this is only a bear market rally and things, things may get worse. But let's hope this current rally continues and things start improving. The market tends to rally when things are negative. That's pretty normal. When the masses tend to go one way, the market tends to go another way. All that to say is, have stocks bottomed yet? It's anyone's educated guess. We will see. To that extent, if you would like a second opinion on your portfolio, you can go on our website. You can click on the Contact Us tab that's in the upper right-hand corner. Click on that, fill out the information, and one of our advisors will reach out to you to answer your questions and to give you some guidance on where the markets are and how they potentially affect you. Thanks again for watching. Bye-bye.